Welcome back to the Deep Dive. Today, we're going to be diving into a real classic in the world of finance and investing,
Oh, yeah.
The Intelligent Investor by Benjamin Graham.
Yes.
This is a book that's, stood the test of time, and it's really relevant even today.
hmm
So if you're looking to level up your investing knowledge and just your understanding of the financial world in general,
Absolutely.
make sure to like and subscribe to this channel for more deep dives, just like this one.
Yeah, and I think sometimes when people hear the title, they think, oh, the intelligent investor, that must be for, Wall Street hotshots or people with MBAs.
Right. Yeah.
But it's really not. What's fascinating about Graham's approach is he's not trying to turn you into a day trader or some kind of financial wizard.
Right.
He's focused on making you an intelligent investor, someone who can build wealth steadily and safely over the long term.
Yeah. And he does a great job right from the start of throwing down a challenge, I think,
Yeah.
by kind of distinguishing between these two key concepts, investment and speculation.
Right.
Could you elaborate on that a bit for us?
Sure. He's not saying that all speculation is bad, but
Yeah.
he wants you to be really clear about the game that we're playing.
Okay.
So when he talks about an investment operation, it involves really digging into a company's financials, understanding its intrinsic value. You're essentially becoming a part owner of that business and thinking long term.
Right.
Speculation, on the other hand, is more about trying to predict those short-term price movements.
Right.
And it can be a lot closer to, well, gambling.
So is it kind of like, I don't know the difference between carefully researching a business partner versus just, betting on red at the roulette wheel?
Exactly.
Right.
And that's where this idea of intelligence comes in.
Yeah.
Because Graham argues that successful investing is less about your IQ
Interesting.
and more about your temperament.
Oh, that's really interesting. So he's saying it's more about like controlling your emotions than being able to, crunch numbers or...
Absolutely. He really emphasizes that emotional discipline.
And he even uses a lot of historical market data to kind of illustrate how dangerous it can be to get caught up in the hype.
Yeah.
He points to the new era bull market of the 1920s and, that subsequent crash.
Oh, right. Yeah.
Or the Nifty 50 stocks in the 1970s.
Yeah.
These are all cautionary tales of speculative excess.
So how does an intelligent investor kind of navigate these turbulent waters?
Right.
What practical steps does Graham suggest for kind of steering clear of those pitfalls?
Well, he outlines two main approaches in the book, the defensive investor and the enterprising investor.
Okay.
And you can think of the defensive investor as someone who's really prioritizing safety and simplicity.
Okay. Yeah.
They're not necessarily aiming to beat the market. They're just aiming to build wealth steadily over time.
Sounds pretty sensible.
Yeah.
But how do they actually, put that into practice? How do they put their money to work?
Well, he recommends a classic 50-50 portfolio split.
Okay.
50% in high-grade bonds.
50% in high-grade common stocks.
And the key is...
And here's the key, rebalancing regularly.
Okay.
So when the stock market rises
Right.
and your stock portion exceeds 50%, you sell some stocks and buy more bonds to restore that balance.
Right.
And vice versa when the market dips.
So you're not trying to time the market or predict these swings.
Right. Yeah.
You're just kind of maintaining that discipline and
Exactly.
taking advantage of the fluctuations.
Taking advantage of the fluctuations.
Right.
You're essentially buying low and selling high, but in a systematic way.
Yeah.
And resisting that urge to chase those hot stocks or panic sell when the market drops.
Makes sense.
Yeah.
Now, on the other side of the coin, you have the enterprising investor.
Right.
So this is someone who is willing to maybe put in a bit more effort.
Yeah.
Spend some time maybe analyzing companies in depth.
Right. They're seeking opportunities to potentially outperform the market.
Okay.
But even for them, Graham emphasizes starting with a really solid foundation. So even the enterprising investor should start with that core of high-grade bonds and reasonably priced stocks.
So even for those seeking higher returns, it's not about, going all in on, risky bets or anything like that.
Yeah.
It's about building on that strong base.
Exactly. And he even provides some don'ts for enterprising investors that I think are surprisingly relevant even today.
Okay.
He advises against junk bonds, foreign bonds, new issues, IPOs, and especially day trading.
Wow, that's it's really fascinating how some of these warnings, still hold true. Decades later.
Yeah.
But let's face it, the market does fluctuate sometimes wildly.
Yeah.
So how does Graham kind of address that inherent volatility?
He introduces this brilliant analogy called Mr. Market.
Okay.
And imagine Mr. Market as this emotional fellow who shows up at your door every day, offering to buy or sell you stocks at whatever price he's feeling that day.
Right.
Sometimes he's euphoric, other times he's depressed.
I'm starting to get it.
So the key is to not let Mr. Market's mood swings
Exactly.
dictate your decisions.
You need to have your own independent assessment of what a business is truly worth.
Right.
And that's where security analysis comes in.
Oh, okay.
That's how you kind of cut through the noise and
Right.
and make those informed decisions.
Okay, so to avoid being swayed by, Mr. Market and all his emotional ups and downs,
Right.
you really need to have this understanding of what a company is worth.
Right.
And that's where I guess security analysis comes in. And that's the part that maybe sounds a little intimidating to some folks.
Sure.
Do we need an MBA to kind of keep up here?
Not at all.
Okay.
Graham lays out these basic principles in a way that I think anyone can grasp.
Okay.
It starts with this idea of really digging into a company's financial reports.
Yeah.
Their income statement, their balance sheet, their cash flow statement.
Mm-hmm.
And you're essentially looking for clues about their profitability, their assets, their debt levels. So it's kind of like being a financial detective.
Right.
Piecing together these clues
Exactly.
to see if a business is healthy.
That's a great analogy.
Okay.
And Graham goes further. He outlines specific things to look for when you're analyzing bonds versus stocks.
Okay.
So with bonds, it's all about assessing safety,
Mm-hmm.
Can the company easily cover its interest payments? What's their overall financial strength?
And with stocks, you're trying to kind of estimate that future earning power,
Right.
projecting out where the company might be down the road.
Exactly.
Right.
But he cautions against getting too carried away with what he calls those growth stocks,
Mm-hmm.
the ones that everyone expects to just, skyrocket in value.
Right.
Because the future is inherently uncertain. Even the best analysis can be wrong.
Yeah.
And he was really big on this idea of a margin of safety,
Okay. Yeah.
which I think is crucial to understand.
Yeah. Absolutely. Can you kind of unpack that for us a little bit?
Yeah.
What is that margin of safety? And why did Graham consider it so essential?
Well, the margin of safety essentially means buying a security at a significant discount to its intrinsic value.
Okay.
Think of it as a buffer, a cushion to protect you if your analysis is even slightly off,
Right.
or if unexpected events occur.
So let's say you believe a company's worth $100 a share,
Right.
but you're able to buy it for $60.
Right.
That $40 difference, that's your margin of safety.
Exactly.
Oh, okay.
And Graham argues that the bigger that margin of safety, the better.
Mm.
He even goes so far as to say that a true margin of safety is what separates an investment operation from speculation. You're not just hoping things go right.
Yeah.
You're building in protection in case they don't.
That makes a lot of sense.
Yeah.
But how do you go about determining a company's intrinsic value in the first place?
Mm-hmm.
I mean, isn't that kind of a subjective thing?
It does involve some judgment,
Right.
but it's not about pulling numbers out of thin air. Graham provides a framework, a set of principles for analyzing those financial statements.
Yeah.
And evaluating a company's earning potential.
Right.
It takes work.
Yeah.
But, that's what separates the intelligent investor from the gambler.
Right.
And, it's interesting because Graham dedicated a whole chapter to investment funds, what we now call mutual funds.
Oh, right. Yeah, you mean those funds that pool money from a bunch of different investors to buy, a basket of stocks or bonds or whatever.
Exactly.
Yeah, it seems like he was kind of ahead of his time on that one.
He really was.
Yeah.
And even back then, he recognized both the advantages and the drawbacks of these funds.
Okay, so what did he see as the benefits?
Well, for one, diversification.
Okay.
Instead of putting all your eggs in one basket,
Right.
you're spreading your risk across a range of companies.
Mm-hmm.
And then there's the professional management aspect.
Okay.
So in theory, you have experts making decisions on your behalf.
Makes sense.
Yeah.
But there must have been some downsides too, right?
Oh, absolutely.
Okay.
He was very skeptical of the fees that these funds could charge, pointing out how they can really eat into your returns over time.
Right.
And even with professional management, I noticed that many funds don't consistently outperform the market.
So even back then, he was warning folks about, watch out for those high fees.
Right.
Some things never change, right?
It seems that way.
But if he was kind of wary of those traditional mutual funds, I wonder what he would think of index funds. which are so popular these days?
That's a great question.
Yeah.
While he was skeptical of some aspects of investment funds, he did acknowledge their potential value,
Okay.
particularly for those defensive investors seeking simplicity.
Right. So even back then, he saw the appeal of kind of that set it and forget it approach for certain investors.
Yeah.
I mean, index funds kind of seem like they fit that bill perfectly.
They do.
Yeah.
And their low fees would have likely appealed to Graham. He was always emphasizing minimizing costs.
Yeah.
But before we get too deep into, modern investment strategies,
Right.
I think it's important to address the relationship between investors and advisors.
Yeah, that's a crucial topic,
Right.
especially for those of us who maybe don't have the time or the expertise to,
Right.
do these deep dives on every company's financials and whatnot.
Right.
What did Graham have to say about choosing a financial advisor? Choosing a financial advisor is a big decision, It's like trusting someone with a piece of your future.
It is.
So what advice did Graham offer on finding the right person for the job?
Well, he stressed the importance of due diligence.
Okay.
You can't just take someone's word for it.
Right.
You really got to check their credentials, their experience, their track record.
Right.
See if there have been any disciplinary actions.
So it's kind of like interviewing a job candidate, Really got to vet them thoroughly.
Vet them.
So what kind of questions should you ask a potential advisor? I mean, I wouldn't even know where to begin.
Well, Graham suggests asking about their investment philosophy.
Okay.
How do they approach the market? What's their track record?
Right.
How do they measure success?
Oh, okay.
And of course, you need to understand their fees,
Right.
how they get paid.
Yeah.
Transparency is key.
Yeah, I imagine that's where things can get a little tricky.
Yeah.
Those fee structures can be so complex.
Absolutely. But beyond all the practicalities,
Yeah.
Graham really emphasizes the importance of trust.
Okay.
You need to feel comfortable with your advisor, confident that they have your best interests at heart.
It's your money on the line, so you want to feel good about the person who's guiding you.
Exactly.
Now, we talked about, the defensive investor and their approach. Let's circle back to those enterprising investors for a second.
Right.
What kind of strategies did Graham suggest for someone who is, willing to kind of dig a bit deeper?
Well, he acknowledged that consistently beating the market is incredibly difficult,
Yeah.
even for seasoned professionals.
Right.
But he outlined a few strategies that he believed could give enterprising investors an edge.
Okay, I'm all ears.
Okay.
What kind of strategies are we talking about?
One of his key principles was looking for unpopular or neglected stocks.
Okay.
These are companies that have fallen out of favor with the market for some reason, but where the underlying business, in his view, remained fundamentally sound.
So it's about finding those hidden gems that everyone else is overlooking.
Yeah. It can be quite a challenge.
Yeah.
He also talked about looking for bargain issues.
Okay.
These are stocks that are selling for less than their net current asset value, meaning you're essentially buying the company for less than the value of its liquid assets.
That sounds almost too good to be true.
It can feel that way,
Yeah.
but it's rarely that simple. You have to do your homework,
Right.
make sure there aren't hidden liabilities or other red flags.
So you really got to do those deep dives
You do.
for the enterprising investor.
Yeah.
Didn't Graham also talk about investing in what he called special situations?
He did.
Okay.
These are often triggered by events like mergers, acquisitions, reorganizations, spin-offs.
Okay.
And they can create some unique opportunities for investors who understand how to analyze these complex situations.
So it's about spotting those opportunities where the market maybe isn't fully pricing in the potential.
Exactly.
That takes some expertise.
It does, but Graham always emphasized that even with these more enterprising strategies,
Right.
the core principles still apply. You
Right.
need to do your research, understand the business,
Right.
and only invest when you have that margin of safety.
It all comes back to those fundamentals.
It does. Yeah.
Well, the intelligent investor really does offer, I think, some timeless wisdom, whether you're a seasoned investor or just starting out.
Absolutely.
And speaking of starting out, if you're looking to learn more about investing in personal finance,
Yes,
make sure to subscribe to this channel.
please do.
We'll be bringing you more deep dives into fascinating topics just like this one.
We will.
It's been a pleasure diving into the intelligent investor with you today.
Likewise.
Graham's message is about much more than just picking stocks.
It is.
It's about, thinking clearly,
Mm,
controlling your emotions,
right.
making rational decisions in all aspects of life, really.
Absolutely.
Well said. And that's what the deep dive is all about.
Yes,
Exploring new ideas and empowering you with knowledge.
that's right.
Thanks for joining us.